Hi, what I'll do now is talk about the final aspect of accounting for financial instruments, and that is hedging. And hedge accounting is quite challenging because the aim of the regulation is to give accounting effect to economic hedges. What this means is that we need to balance off the gains and the losses between hedging items and hedged items. And that's been what has challenged the standard setters the most, and you can see this in the regulation. When we think about hedging, it's going to be undertaken with qualifying instruments, and these qualifying instruments are often going to be derivatives. However, that's not necessarily the case, and derivative and hedging might be undertaken with non-derivatives as long as they're recognised on a fair value through the profit or loss basis. Quite obviously, any hedging must be undertaken with parties external to the firm. In terms of designating hedge instruments, we need to understand that a qualifying instrument must be designated in its entirety as a hedge. You can't designate half of an option as a hedge. And qualifying instruments may be aggregated. So you might get a combination of derivatives which represent the hedge. So we need to understand that sometimes aggregation is going to be necessary. That's not a problem. Hedging is applied to hedge items, and hedged items are going to be qualifying items, and these qualifying items are items which are already recognised as assets and liabilities, unrecognised firm commitments which are going to give rise to assets and liabilities, forecast transactions, or the net investment in a foreign operation. You might remember when we did foreign currency translation, we ended up with foreign currency gains and losses on translation. That's what we're talking about here. The characteristics of hedged items is they must be reliably measurable and they must be sufficiently probable. What we're really talking about there are the unrecognised firm commitments and the forecast transactions. For an item to qualify for hedge accounting, you must have both eligible hedged and hedging items. There must be the formal designation of the hedging item as a hedge, and there must be documentation from inception, and it must be effective. And when I'm talking about effective, I mean it must be effective from an economic perspective, and that relationship can't be undermined by credit risk. There are a range of hedging relationships that we might have, or what types of hedges we might have, and these are fair value hedges, and fair value hedges can be thought of as hedges of existing assets and liabilities in the financial statements or firm commitments. There might be cash flow hedges, which are hedges of future transactions, forecast transactions, and hedges of net investment in foreign operations. This is the hedges of those translation exposures. In terms of how we account for them, fair value hedges have never been particularly problematic because the gains and losses on the items that we're hedging are recognised in the P&L generally. So gains and losses on hedging items are generally recognised through the P&L as well. And this matches up with the gains or losses on the hedged items, which are also generally recognised through the P&L, and that makes life pretty straightforward. The gains and losses balance out in the statement of profit or loss, and we give accounting effect to an economic hedge. It's a little bit more problematic when you have an unrecognised firm commitment, and in these circumstances you need to recognise that as part of the value of the asset that's being purchased. Cash flow hedges are a lot more problematic, and cash flow hedges are problematic because what we're doing here is that we're hedging gains and losses on forecast transactions, and we don't recognise forecast transactions or future transactions. So the issue here is, what do we do with them? We need to recognise the derivatives at fair value. That's not the question. It's a question of what we do with the gains or losses. And so what we do for cash flow hedges is for the cash flow hedging item, we recognise them at fair value, and we recognise the effective component of the hedge in other comprehensive income. It gets aggregated as cash flow hedge reserve. If there's a part of it which is ineffective, we recognise it in the statement of profit or loss. If that gain or loss on a cash flow hedges is associated with a non-financial asset or liability, it can also be included in the initial cost of that asset or liability. So if I have a forecast transaction of purchase of inventory, any gains or losses on the hedge before I recognise the inventory would be included in the cost of the inventory. If the hedge becomes ineffective, the gain or loss gets recycled into the income statement. If it's effective, it's get included in the cost of the inventory, and it goes into the income statement as part of the cost of inventory when the inventory is sold, cost of goods sold. So for cash flow hedges, what we effectively use is other comprehensive income as a store or a warehouse where we park the gain or loss until we recognise the underlying transaction. For hedges of net investment in foreign operations, it's pretty straightforward. The gains and losses on foreign currency translation went to a foreign currency translation reserve through OCI, and likewise the hedges need to be treated in a corresponding manner. There are a few extra bits which just need to be cognizant of. There is provision for evaluation of hedges on an aggregate basis, so groups of items rather than individual assets. And that's going to be very common in the financial services sector, banks. And we also need to appreciate that hedging may be undertaken with credit derivatives for credit risk, and to the extent that the underlying assets or liabilities are recognised, gains and losses are recognised in the income statement, then quite obviously credit derivatives are often going to have the gains or losses recognised in the statement of profit and loss as well.